Right now, this tech giant is surging, pulling out of a falling trend with massive buy signals. And, some models still call it aggressively undervalued.
Right. But with insiders quietly dumping shares, it really begs the question.
Exactly. Are retail investors walking into a massive value trap?
It's definitely the ultimate market contradiction right now.
Yeah. So today is Friday, April 17th, 2026, and we are doing a deep dive into Meta Platforms, Inc., Meta. We're going to tear through the financial statements, the technical charts, and those insider flows we just mentioned to debate the true value of the stock.
There is a lot to unpack here, especially with the divergence between what the data says and what the executives are actually doing.
For sure. Real quick before we jump in, just a reminder to everyone listening, this is strictly an educational exploration of the data.
Yeah.
We are absolutely not giving any financial advice here.
Yeah, no financial advice. We're just, looking under the hood at the source material.
Right. And hey, if you like this deep dive, please subscribe to our YouTube channel and make sure to leave your feedback in the comments. It's compulsory. We really want to hear from you.
Definitely. So to understand if a stock is a trap, you first have to look at the actual engine, right? The core financials.
Let's get into it. Looking at the 2025 income statement, the numbers are just, they're staggering. Revenue hit $200.97 billion.
Yeah, a $200 billion scale is just wild to think about.
It really is. And the net income margin is sitting at 37.42%.
Which is incredibly high for a company of that size.
Right. To keep, over 37 cents of profit on every dollar at that scale, that shows a lot of pricing power.
Yeah.
And that brings their trailing 12-month EPS, the earnings per share, to around 28.94 to 29.23.
The balance sheet looks like a fortress too, at least at first glance.
Oh, absolutely. They have a war chest of $81.59 billion in cash and marketable securities.
Against, what was the long-term debt?
Let's see, long-term debt is $58.74 billion. So manageable. But then you look at the cash flow and things get a little tricky.
Yeah, this is where the context really matters. So operating cash flow came in at a massive $115.8 billion.
Okay, sounds great so far.
Right, but then look at the free cash flow. It's only $43.59 billion.
Wait, that's a huge drop-off. Where's all that cash going?
It's the capital expenditure, the CapEx. In 2025, they spent a massive $72.22 billion on infrastructure.
Wow. $72 billion. That's not just software updates.
Exactly. That is pouring concrete, building massive data centers, buying up all the AI silicon they can get their hands on. It's an infrastructure arms race.
And that ties directly into the valuation debate, right? Because the stock price right now is $678.30.
Which is basically sitting right in the middle of their 52-week range of 479.8 at the low and 796.25 at the high.
Right. So analysts see a PE ratio of roughly 24.8x, and they compare that against an estimated fair ratio of 42.6x, and they say, hey, this is undervalued.
But that $72 billion CapEx spend complicates that narrative completely.
Okay, let's unpack this. A PE of 24.8x for a company making $200 billion. That's like finding out the nicest mansion on the block is selling for a 40% discount. It makes you wonder, is the foundation sinking?
That is the perfect way to look at it, because to see if that foundation is sinking, we need to see how the broader market is pricing this in right now.
Which means looking at the technical action. And the recent trend direction is, well, it's aggressive. Since April 1st, the stock has gained 17.1%.
Yeah, that is a high conviction recovery. The technicals show Meta is in a clear bullish breakout right now.
What are the key levels you're seeing on the chart?
So it just reclaimed the critical Fibonacci 0.618 level at 6759.15. That was a major hurdle.
Oh, nice. So where is it aiming next?
It's eyeing the 0.786 target up at 697.01. And if you look at momentum, the RSI is recovering from the mid-60s.
So it was oversold, but it isn't overbought yet.
Exactly. It still has some breathing room. Plus, it's trading 11.5% above its 200-day EMA, which is all the way down at 594.09.
So the moving averages are acting as a strong net underneath it.
Yeah, it's finding really solid key support at 639, which is that 20-day EMA zone, and again at 659. Immediate resistance is hovering right around 680 to 685.
Okay, and this is where it gets really interesting. Because when you look at the institutional order flow,
there is heavy, heavy buy-side pressure right now.
Yeah, tracking institutional order flow is like watching the water recede before a wave. You see big funds prepositioning at 655 to 663, and they're placing their bets right before the April 29 earnings drop.
They clearly expect a positive catalyst from that earnings call.
Right, but if everyone is so bullish and funds are buying up millions of shares, who is taking the other side of the trade?
And that right there is the million-dollar question. Because that leads us straight into the glaring contradiction in all of this data.
The insider selling.
Yep, the catch. Because if you look at the ratings, 88% of Wall Street analysts rate Meta a moderate to strong buy.
With consensus targets, what, around 846 to 855?
Yeah, and Evercore ISI is aiming as high as 900. They are incredibly bullish.
But the negative signal here is deafening. Over the last 12 months, 8 insiders sold $401.39 million in stock.
Almost $500 million.
And guess how many insider buys there were in that same period? 0. Not a single one.
What's fascinating here is the specific timing and who is doing the selling.
Right. In March 2026, you had the COO, Arvon, and Director Robert Kimmett selling large blocks.
And they were selling between 605 and 632. Add to that, overall institutional holdings actually saw a slight 1.12% dip recently.
So if the stock is so undervalued, like the analysts say, and it's heading to 900, why are the people running the actual company cashing out in the low 600s?
Because they see the internal dashboard. They know the risks that the retail market might be ignoring. And this is why retail traders often get trapped here.
How so? Walk us through that retail trap.
Well, a retail trader sees the chart breaking out, right? They see the RSI looking good, they read an article about an 88% buy rating, and they jump in right at that 600 to 685 resistance level.
Thinking it's going to the moon.
Exactly. But they are providing the exact liquidity those insiders need to safely exit their $400 million positions without tanking the price.
Wow. So retail is buying the hype right when the smart money is quietly slipping out the back door.
Exactly. So to figure out if the insiders are right to sell or if the analysts are right to buy, we really have to look past the short-term earnings. We have to examine the long-term fundamentals.
The horizon. Okay, let's start with the bull case, the absolute best case scenario. The long-term growth story here is massive. Meta is projected to overtake Google in global ad revenue this year in 2026.
Which is a monumental shift in the digital ad landscape.
Huge. And a big driver for that is their Broadcom AI chip partnership. They are leading AI integration with that MuseSpark model.
Yeah, MuseSpark is a game changer for ad targeting.
Plus, they are finally making real progress on WhatsApp monetization. You combine all that, and the growth looks unstoppable.
It does, but, we have to counter that with the bearish risks, because the worst-case scenario here is pretty severe.
Right, bring us back down to earth. What's the biggest threat?
It goes right back to what we talked about in the engine room, that CapEx explosion.
The $72 billion from 2025.
Right, but it gets worse. Projections for FY 2026 show CapEx hitting a mind-bending $162 to $169 billion.
What? Wait, so what does this all mean? They spent $72 billion on CapEx in 2025, and now they might spend up to $169 billion.
That is the projection, yes. The AI infrastructure race is incredibly expensive.
It's not just building a moat, that's building a financial black hole. At what point does depreciation just eat all their profits?
That is the exact fear driving the bear case. When you buy $169 billion worth of servers, you have to depreciate that over a few years. That is a massive guaranteed hit to your earnings quarter after quarter, regardless of how well MuseSpark performs.
So even if revenue goes up, the profit margin could get squeezed tight.
Exactly. And there are other bear factors too. Geopolitical and legal risks are piling up.
Yeah, like that recent $375 million civil penalty in New Mexico over child safety. That's a huge headline risk.
And operational risk if they have to change how their algorithms push content. But financially, the U.S.-China trade tension is the real sleeper threat.
Oh, right, because a lot of their ad revenue comes from overseas.
About 11% of their total revenue is tied to China-linked advertisers.
Like Temu and Shane basically buying up all the ad space on Instagram.
Precisely. And if trade tensions escalate or tariffs hit those cheap goods, those companies can't afford to spend billions on Meta ads anymore. That 11% chunk of revenue is highly vulnerable.
So you have costs skyrocketing to $169 billion, while 11% of your revenue could vanish over a tariff dispute.
Which perfectly explains why the COO might want to take some chips off the table at $630.
It makes complete sense when you frame it like that. Yeah. So let's summarize this outlook. What are we actually looking at here?
Synthesizing it all, the short-term outlook over the next few days or weeks, the momentum is undeniably bullish. The charts want to push higher. It's looking to test that $697 to $700 resistance before the April 29 earnings.
But the long term.
Long term, it is an absolute battle. You have this unprecedented AI growth and WhatsApp revenue potential fighting against terrifying CapEx risks and depreciation.
It's a tug of war between the algorithms and the actual accounting math.
Exactly.
Well, the math says it's undervalued, the charts say it's breaking out, but the executives inside the building just cashed out over $400 million. If the architects of the company are taking their chips off the table, should you really be putting yours down?
That's the question you have to answer before you hit the buy button.
Something to seriously mull over.
Yeah.
Thank you all for joining us on this deep dive. Don't forget to like, subscribe, and drop your thoughts in the comments. We will catch you on the next one.